Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our webinar today as we discuss the pros and cons of renouncing US citizenship and whether or not it's worth it. So we'll get into that discussion soon. So we'll begin shortly. So I will be one of the moderators of the webinar alongside our panelists of guest speakers who I'll be introducing. And so everyone will be put on mute as soon as the presentation begins, but feel free to ask any questions in the chat or in the Q&A section, and we'll do our best to answer them for you or interrupt the speakers to get their thoughts on the matter as needed. This webinar is being recorded, and the recording will be shared on their YouTube and social media channels afterward. And with that, all that said, just before we start, also a few disclaimers to go through for compliance, so just bear with me for a second. The information presented is for educational purposes only, does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. The investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. So with all that said, what I'd like to do now is just briefly introduce our speakers for today's webinar. So if you just bear with me a moment, I'd like to first introduce our first speaker is Charlotte Davies, who is a US enrolled agent and member of the Association of Tax Technicians, who has worked in the UK and the US with tax matters for more than 10 years. She specializes in US and UK taxation and reporting for trusts and their beneficiaries, and is a member of the Society of Trusts and Estate Practitioners. Also with us today is Nathan Pryor, who's partner and head of Partners Wealth Management International. He's worked not only with UK-based families, but also those non-domiciled in the UK and those that have personal US tax considerations. Also with us today is Brian Dunhill, who is the director of Dunhill Financial. He is a financial planner with core emphasis on concentrated positions, retirement planning for expatriates, and lots of experience in the US expat space. So with all that said, I think it'd be great if we start by handing it over to Charlotte, who will take us through her presentation on the aspects of, well, we just talked about renouncing US citizenship and sort of the tax-based aspects of that. So Charlotte, would you, you wouldn't terribly mind, take it away, please. I think you're muted, sorry.
There we go, unmuted.
Yeah, it happens a lot. It's okay.
So what I'm going to start talking today about is the challenges of being a US citizen in the UK. I'm sure that many, if not all, of the people on this webinar today are painfully aware of the reach that the IRS has over their lives. So we're going to be talking about one of the main issues, one of the main challenges that you would say would be the reporting regime and the reporting obligations that US citizens are subjected to. So as a US citizen in the UK, you're required to report your worldwide income and gains to the US authorities on an annual basis. I'm sure many of you guys are aware of that one. But additionally, you are required to subject yourself to a reporting burden on an annual basis as well. So as a US person, you have to tell the IRS about any number of things, mainly to do with your non-US financial interests. So the most commonly seen reporting requirements that US people in the UK have are, you'll see on the slides here, foreign bank account reports, your form 114, and your form 8938. Both of these forms, you're required to submit details of your foreign financial assets. This reporting regime, and most of the US reporting regime, doesn't necessarily generate a tax liability, it's informational. So you're required to tell the IRS and the Department of Treasury a bunch of information on an annual basis. If you have investments in non-US assets, such as certain kinds of investments, but if you've also got interest in things like UK companies, UK trusts, or any kind of non-US, I should say, not just UK, financial assets, you will have to tell the IRS, you'll have to complete a form, and those forms can be burdensome, they can be complicated, and it's important to get the appropriate guidance with these forms. So you'll see here on the slides about the reporting thresholds for these most normal forms, the kind of most commonly seen forms. And and they will form either part of your tax return on an annual basis, or the FBAR needs to be submitted separately to the Financial Crimes Enforcement Network. So it's not simply a case that you have to file a tax return, you also need to gather a lot of information and submit a lot of information to the IRS on an annual basis. So why do we care about submitting these forms? Well, if you don't submit them correctly, you're potentially subject to penalties. So Josh, if you wouldn't mind just moving to the next slide. You'll see here the penalties for failure to file these most commonly seen forms. So the FBAR and the 8938 have got $10,000 starting penalties if you don't file them. But depending on whether your failure to file is willful or not, the IRS and the Department of Treasury have scope to increase these penalties significantly. Clearly, you know, there are circumstances when people aren't necessarily aware of their filing requirements. And so there are some amnesty schemes where you can bring your filings up to date. So I don't want this to be one of these things that just kind of puts the fear of God into people, but it's emphasizing here that if you don't file these forms, even if no tax is at stake whatsoever, you are still open to penalties issued by the IRS. I've also included here, just to give you an idea of the scope of these penalties, the penalties for the form 3520, which is a form that is required if you have interested in a non-US trust. The penalties can start at $10,000, but the IRS has the ability to issue penalties determined on the basis of the assets within the trust, which for some clients could be way in excess of a $10,000 penalty. So again, just to emphasize, these are penalties if you don't do what you're required to do. You know, if you have appropriate guidance, if you have appropriate support and advice from people who are comfortable advising on these matters, these can be avoided. But it's important to be aware of what these reporting burdens are and how they need to be completed on an annual basis. So that's the kind of core difficulty of being a US person in the UK. You've got to file a lot of paperwork, you've got to submit a lot of forms to the IRS and the Department of Treasury. Another point to bear in mind would be about the mismatch of certain treatments between the US and the UK. So it's quite easy to get into the mindset, well, I live in the UK, these things are tax preferred, tax advantaged, or tax free, but you have to bear in mind you've got to look through everything through the prism of your US citizenship status. So just because something is tax-free from a UK point of view doesn't mean that it is from a US point of view. And the most commonly seen of these issues would be on the sale of your main home, for example. The UK is incredibly generous, doesn't look to tax people on the sale of their main home, but the US is less generous. And so if your gain is more than $250,000 in the US, if you're filing singly or separately, it's $500,000 if you're filing jointly, you would be expected to pay some US tax on the sale of your main home. So again, mismatch of treatments between the US and the UK can throw up some surprises if you're not aware of them. The next issue, which Brian and Nathan will go into in a lot more detail, is about investments. So for me as a British person, I'm able to just go to a high street bank, invest in a stocks and shares ISA, without any problems or concerns or anything like that. As a US person, again, it's really important to bear in mind that you need to look at what you're investing in, not just from a UK point of view, but from a US point of view as well. And some of these off-the-shelf investments aren't really going to be suitable for you in the way that they would be for a British and solely British person like myself. So again, to reiterate, with appropriate guidance and advice, these investment options are available to you still, but you just need to make sure that, again, you're looking at everything through the prism of your US citizenship status. It's never possible as a US person overseas to just think that, okay, well, the country that I'm resident in allows me to do X, Y, and Z. You always need to make sure that you're considering things from the US angle. Again, I'm not a big fan of scaremongering or anything like that. This isn't to say that, without guidance, you're going to end up being whacked with a giant US tax bill. That's not the case if you're properly structured and you're properly guided, but you need to be aware of the pitfalls that you could potentially or accidentally stumble into. And so in these kind of circumstances, you just need to make sure that you're aware of the US implications of the financial decisions that you make, as well as bearing in mind the reporting burden and the reporting that's required on an annual basis from a US point of view. I think that's a quick gallop through the various issues in hand at the moment. These slides, the covered expatriate slide that comes up is to do with my next section of the talk. So I think if we move on to Nathan, he'll be able to tell us a little bit more about the issues to do with the investment angle and what investments are available to US people.
Thanks, Charlotte. That's a great start there, just to kind of make everybody start thinking, hang on a minute, I've got all these forms I need to sign, I've got all these potential penalties, you know, why do I want to be a US citizen? I go into my bank, I want to open an ISA, and they tell me no, I can't even invest. What's going on? So yes, I think, you know, we get a lot of people who you know, when first realizing they've got these issues and concerns, you know, start thinking, well, hang on a minute, you know, I can't invest anywhere, I can't do anything tax efficiently, I can't, you know, plan my finances, I've got all this admin burden, etc. So I just want to spend a little bit of time here just kind of talking through a few of those kind of potentially perceived restrictions that that people have, and what's real and what's not. And I think the first one being that idea of, you know, I go into a bank and nobody wants me. and that works in both sides of the coin here. You go into, you know, you try and open a US bank account, they go, well, you're not resident in the US, clear off, we're not interested anymore. You go into a UK bank and they say, well, hang on a minute, what's this American passport thing you've got? That's far too scary for us. We have to do all sorts of reporting to the US if we've got US clients, so we don't want to get involved there either. And your world starts shrinking and you start thinking, hang on a minute, I can't actually do anything I want to do. So firstly, to kind of get past that myth, you know, there are places that are set up willing and able and you know, purposely set up to help you. And I would argue that if you can work with the companies, the financial institutions, the advisors who are set up purposely to help Americans here in the UK, that's going to be a lot better than trying to wiggle your way through to convince some of these other companies to work for you. Yes, if you manage to get a US bank to let you have an account open and you do some investments and things with them, that might be fine, but you might end up finding you're causing yourself trouble later down the line with you've not got information in an easy format to do your UK tax returns, or indeed you might have bought some things that wouldn't be tax efficient in the UK. Same the other way around, you managed to convince a firm in the UK to let you invest with them. If you buy some funds that are not US tax compliant, that can be extremely painful, and you know, you definitely don't want to go down that route. And the same again, you probably won't be getting information in the formats that gives you the right tax reporting. But there are a number of firms out there that are purposely set up to make sure that you can invest in the right types of investments. They can give you the investment and tax information in a way that will help you do those tax forms. The other bit there being, well, can I be tax efficient with my investments? You know, everything I try and do seems to be no, don't do that. That's not good for you. But there are most certainly things that you can do that are tax efficient. You know, one of the main things is your pension savings, your retirement savings. This is probably still the most important thing for most people to focus on. It's still going to be hugely tax efficient. You just need to be mindful of what your allowances are and how that's going to interplay with your personal circumstances. So don't ignore your pension savings. Do think about that, and do get advice if you need help with your allowances. Other things that are going to be helping you be efficient is making sure you're investing in a way that is sensible from a taxation point of view, in terms of, are you investing for capital gains rather than income tax and things like that. That's relevant whether you're in the UK or in the US. So make sure that you're bearing that in mind. And don't ignore the marginal tax benefits of things as well. ISAs is one of those things that people often get told, no, that's no good for you, you know, you can't invest in an ISA. That's not really true. A lot of ISAs in high street banks, yes, they would be inappropriate, because you might just get the option of only buying a fund or something like that. But if you invest in a stocks and shares ISA that allows you to buy individual shares, individual securities, then there's nothing inefficient about that in the US. They will still be treated as normal investments, taxed in the appropriate way, but you can still get your UK tax efficiencies, and that may be quite beneficial for you, certainly if you're paying more tax in the UK than you would otherwise in the US, which most people are. And then finally, the question of, well, you know, with all of this stuff and constraints and things like that, you know, it's not worth me doing any planning or things along those lines. I would say it's almost the inverse with the difficulty and constraints here. Actually, it's really, really, really important to get some good advice. Make sure you are doing things as efficiently as possible. Make sure you're avoiding all the mistakes that could crop up even if you don't know about it, and make those marginal gains, which when compounded and run for multiple years, can give you a very tax efficient way of running your finances, a very admin efficient way of not making mistakes. And I think probably this is a good time to ask Brian to say, well, what are some of those investments that we can do that might be efficient, and how do you do it? I'm going to put myself on mute.
It helps if I unmute myself. Thanks, Nathan, for the introduction there. There's a lot of complexities. You know, if you want to play with the good old band lyric, you've got the 5-man electric band with the you know, signs everywhere there's signs. We have all these rules that we have to follow, and if we're American, they're actually much higher. But Charlotte hit the nail right on top of the head. That we can't be utilizing the high street banks, and the main reason there is it's going to get us in a bunch of problems when it comes to our taxes. We end up falling into mostly PFIC issues if you go with the high street banks. So we pretty much want to keep our investments in the States no matter what we're doing. There's exceptions to this, and this is where the benefits start to play in. Sorry, I've got the most American accent of the three of us, so I get to play the good cop here. I get to have all the fun with that. When it comes down to it, the double taxation agreement between the US and the UK is one of the easiest to deal with in the world. It encompasses some great benefits that basically both countries recognize each other's retirement plans. So you go other places and it gets even tougher than it does over here, which means you have the ability to use your company pension and not have to worry about going back to the States and it not being recognized, or same thing vice versa. So the first thing that you really want to look at from a grand scheme of things is utilizing that company pension. Don't just think about what does the company match and I'll put in that same amount, but using it as a true retirement vehicle. It's a little bit more complex, and there's a few extra widgets in there than what we would have maybe in a 401k back in the States, but it's a great mechanism to put money away with a lot of benefits to the side of that. We get to still double dip as Americans. So if you're doing your taxes in the right format on the credit system instead of the FEIE, the foreign earned income exclusion, you can actually max out your UK pension, and then you can still make an IRA contribution, and you might even be eligible to do a backdoor Roth or a Roth IRA contribution, getting a tax-free deduction on the US side. So there's benefits that, sorry, Charlotte, sorry, Nathan, you don't get these benefits. It's only for us Americans on the call. So now there we're talking about our different retirement savings, things that we can touch later on in life. But you might have a few goals between now and retirement, and that's where we should be talking about some different elements. If something conforms inside of the IRAs or inside of the SIPs, you don't have to worry about PFICs, MiFID requirements for Europe, or the HMRC requirements. You might want to make sure that it conforms, but basically those retirement accounts, however they come off the shelf, you can go ahead and set them up. If you're struggling at finding some place to open up an IRA, we have our full service solution, but we also have a robo-advisor if you're just getting started at DF Direct. So you have absolutely no excuse to be able to set up, because there's no minimums over there. The second tier becomes, like Nathan was saying, with ISAs. It's a little bit complex in this arena. Most of the banks will say as an American, you can't set them up. That's not true. You can set them up as an American it's just not always a great advantage for you, because we get stuck in the nuances of some of the different rules. The US doesn't recognize it as tax-free, but the UK does, which means you might be paying 15% tax in the US instead of paying 20% tax here in the UK. So it might not be that great of a benefit. And on top of that, because we can't buy UK securities inside of an ISA, because then it will become a PFIC on the US side, and you'll pay way more than 15% tax and a lot more to your tax accountant to prepare your taxes. And you can't buy US exchange traded funds. You're stuck in this dilemma that you have to buy individual stocks and individual bonds. This might be appropriate for the high net worth individuals on this call, but for many others, it actually might be disadvantageous to have an all individual stock ISA. It might get you from having diversified portfolios outside to having a more concentrated risk in there. So you'll want to analyze that in depth, whether it fits with your full financial plan and whether it's worth that small reduction in the taxes. So if we've maxed out our contributions in our retirement planning, we've decided whether we want to have our ISAs or not. That just gets to the general investment accounts, as they call them over here, which essentially plays into how we want to structure those. You can use international platforms. They're typically a little bit more expensive, but also you have to find the right ones. But otherwise, you can use many platforms in the United States to make sure that you don't have any PFICs. Just make sure you're buying everything on the US exchanges instead of the London exchange. If you buy the S&P 500 on the London Stock Exchange as an exchange traded fund, it is still considered a PFIC by US rules. So you want to make sure that you buy ETFs or individual stocks on the US exchanges. The second thing is that essentially you want to make sure it's MiFID compliant. We're not part of the European Union anymore, but we still have those adoptions, which basically says it should be managed from the local region. So all of a sudden, if we buy a managed product, a mutual fund in the United States, it's not MiFID compliant. The good news is there's no punishment for MiFID compliant, but there is one for non-HMRC compliant, which essentially Her Majesty the Queen's Revenue Service has a list of different funds. And analyst Cam will tell us, our resident analyst, whether I'm off, but I think there's only about 90 exchange traded funds on that list on the US side. And that just gets you a lower tax bracket here in the UK, 20% instead of your regular earned income side. So you want to make sure you marry all three of those rules so that you don't find yourself paying excess taxes. But it basically means you shouldn't be buying funds over here in the UK. You shouldn't be buying mutual funds in the US. You should only buy exchange traded funds or individual stocks on the US side of things, whether it be through a brokerage channel here in the UK or in the US, so that you're paying the least amount of tax on those general investment accounts to structure for those investments. Plenty of American expat firms like Nathan's firm, like my firm, that are built just to go ahead and take advantage of these and make sure that we're conforming with all the different rules and finding the best way. But as Charlotte said, the high street banks aren't there to help you, and they shouldn't be there because, well, as the newspapers will say, they're kind of dead, first of all, and second of all, they can actually cause lots of problems if they get you in there and buy you those PFICs. That's the quick rundown on what you should be thinking from an investment side before you clean up and you start thinking of other things. Now, going back to charges, Charlotte, what if you decide it's a good time to renounce? How much would we be talking about it costing to renounce?
Well, I mean, if you haven't been able to convince everyone to stay, I guess we need to talk about what you've got to do if you do decide to renounce. So we can talk over the process, and then we can talk over the implications of the process. So the way that we work with our clients who are considering the renunciation process, we'll have a conversation with them about whether their prior year tax filings are up to date. If we go on to the prior slide, I think, Josh, sorry, one sec. There we go. So one of the things when you're considering expatriation, you need to determine whether you're going to be a covered expatriate or not. If you are a covered expatriate, you will potentially be subject to the exit tax. So before we even get to that process, when we're talking to our clients who are considering expatriation, we have to make sure that they've done their previous 5 years of filing. If they haven't done their previous 5 years of filing, or if that's not up to date, they're automatically a covered expatriate. And most clients clearly want to have the least amount of paperwork. They want to avoid the exit tax if they're considering expatriating. So that's the first port of call. Have you done your previous 5 years of tax filings? The cynical side of me, or perhaps, you know, just having lived through a number of expatriations, if a client has prepared their own tax returns, I do ask to have a looky over those tax returns just to make sure that they've covered all of the potential reporting requirements that are involved. Have they reported their interest in the UK limited company? Have they reported their interest in a UK trust, for example? If they haven't, they would need to go back and amend those returns to confirm that they have filed what needs to be filed from a US point of view. There are some clients who discover that they're US people who've never filed a tax return, so they would need to start from scratch in order to get up to the position where they don't need to worry about being a covered expatriate. As I mentioned earlier, there are some amnesty schemes in place where the IRS do recognise that people aren't deliberately not filing their returns. Sometimes they're just not aware of their filing requirements. And one of those amnesty schemes is actually really generous for people who are looking to expatriate. It's called the Relief for Certain Former Citizens. And it basically says once you've expatriated, you submit the prior 5 years of tax returns. You obviously have therefore complied with your requirements that your tax return filings are up to date. So long as your net worth isn't more than 2 million, and so long as that your average net income isn't exceeding the threshold included on that slide there, you can file these prior year tax returns and not have to pay the tax that's due on those 5 prior years of tax returns, so long as the total tax liability is under $25,000. That is wildly generous, and many clients do take advantage of that. So that's for clients, though, that have never filed tax returns before. If you filed tax returns for a period of time and then you didn't, you can't avail yourself of this potential relief. So that's a lesson to learn there. So yes, we look over our clients' filings. Have you filed what needs to be filed? Get yourself up to date if you haven't. Once clients are in the position that they are up to date with their filings, they can then go and request an appointment at the embassy to have the expatriation meeting. Now, I'm sure lots of the people on this call are very aware that the embassy has basically, until very recently, been closed to any expatriation appointments, basically since COVID took place in the beginning of 2020. So at the moment, requesting an appointment at the embassy for expatriation will take some time. There is quite the waiting list, I understand. You're required to submit an application for the appointment on an online system. You'll then be put onto a waiting list. And I'm afraid we have no idea how long that waiting list at the moment is. Is it 6 months? Is it a year? Who's to say? No one's telling us. So it is a little bit difficult if people make this application without necessarily knowing the end date. One thing prior to making the application, sorry, I should have mentioned, is if there's a risk of you being a covered expatriate under the terms that are included on this slide, we can potentially undertake some planning. So if, say, for example, your net worth is hovering above the $2 million threshold, might it make some sense to be generous to your non-US spouse, maybe make a transfer, maybe make a gift, something like that. There are other planning opportunities available as well, depending on what your assets are and whether they're held at a significant gain. We can go into those details perhaps separately offline. But yeah, there are some planning opportunities available for people who are, within shouting distance of this $2 million threshold for the net worth criteria of the covered expatriation rule. So sometimes it might make sense to undertake some planning in 1 year and then expatriate in a later year once you're comfortably below this threshold. So we'll talk through clients with the possible planning opportunities that are available. They then request the appointment. The fee for the appointment is not insignificant. It's $2,350, non-refundable should you change your mind partway through the process. You realise that actually, yes, I will be an American. Sorry, that $2,350 is lost. Then you go in and have your appointment in the embassy. I've heard differing reports of what that embassy interview is like. In prior years, the interview could be quite combative, I understand from some clients. There would be a little bit of an argument about why are you giving up your citizenship? Do you not understand that this is something that people live and die for, so on and so forth. But I think now that the reporting burden for US individuals has increased to the extent that it has, and more people are looking to expatriate, that the interview with the embassy official, where you as a US person who's looking to expatriate explains why, it's no longer as combative as perhaps it has been in the past. Many of our clients who go through the expatriation process simply say that either they don't really consider themselves to be American, they're perhaps kind of culturally British, having spent a great deal of time over here. You know, some US citizens have never really lived in the US. And so, you know, giving up their US citizenship for them isn't as emotive an issue as it is with many Americans, I can imagine. So you'd have the expatriation appointment, you would receive your renunciation certificate. And then from a tax point of view, back where I come in as the tax geek, for the year in which you've expatriated, you're required to submit a dual status return, splitting the year into two halves. The first half, you're a US citizen throughout. The second half, you're a non-US person. For the first part of the year, you're subject to US tax on a worldwide basis. For the latter part of the year after your expatriation, you're only subject to US tax on US sources of income, such as US dividends, for example. You're also required to submit the form 8854, which is an expatriation statement. It includes things like a balance sheet. It confirms whether or not you're a covered expatriate. And you provide all of that information under penalties of perjury to the IRS, confirming your situation. So when it comes to the cost side of things, if you are a good, diligent US person who's been submitting your returns on an annual basis, the actual expatriation process itself is the $2,350 fee. Some of my clients like to have a conversation with an immigration lawyer before they expatriate, just to understand any implications, which I think Brian may come on to in the next section that we talk about. And also to demonstrate in the interview that I am aware of the implications of giving up citizenship. So you don't need to tell me off. That's what some of our clients do. So there may be some cost to do with the immigration lawyers. And then for the final US reporting, or final complete US reporting, there'll be costs to employ someone like me to do these forms. So that's the process in a potted form. Like I've said, the process of expatriating has basically been on hold for the past couple of years. Many people are looking to do so now. So, you know, it's difficult to say if you decided today, in spite of all of our lovely conversation that we're having, that yes, expatriation is the route for me. It may be a drawn out process because of these time constraints at the moment. So Brian, do you want to tell us what we should worry about if we do decide to go down the expatriation route?
I think there are some fallacies out there, and then some things that you actually really need to think about when it comes down to it. You know, naturally, I see the one question that we get to double dip on each side, asking what do I mean by that? I literally mean that we can take advantage and use the retirement system in the United States at the same time as in England. So you're able to make contributions to both sides, which gets more money growing tax deferred. So that's what I mean by double dip. Sorry for the jargon or the childish words that I'm using right there in that. But naturally, if we rescind, if we are no longer U.S. citizens, we're not going to be able to make those IRA contributions, so we can't double dip in those types of ways. You're not going to be able to go back and forth for work. It will be up to the U.S. government whether they allow you to actually enter into their borders. And I've actually heard this, Charlotte. I'd love to hear if you've had the same experience, but I've had some people that have gone into the consulate and they've tried to scare them that even if they're passing through on a flight, let's say through Miami to go to South America, that they might not be allowed to go in the country.
Really?
Not that I've ever heard of anybody being turned down for that, but I've heard more scare
Yeah.
stories of people in the embassy in the first interview round, and then in the second interview they basically say, yeah, probably no problems. Naturally, this is probably more for people that they feel are tax evaders or other problems rather than just your regular person. Now, some other things that you might want to think about. You might not be able to move around in the US as easily as you are used to if you're going back to visit family, friends, and the likes. And for some of us, US elections can be a big deal. You lose your ability to vote. And therefore, for some of us, our ability of listening to you complain about who people have voted for. Sorry for the poor humor there. But to me, the U.S. Consular Service is a wonderful service that hopefully most Americans never really have to utilize in all ways, shapes, and forms, especially when you're on other sides of the world. They can be very helpful when things get a little bit tricky and you lose the ability to use that. So you'll also want to measure what your other passport is and the fact that you need another passport so that you don't become stateless the minute you turn in your U.S. passport. That can be an important one. Now, all of those amongst the $2,350 expense to renounce are certain things to think about. The most expensive thing to think about that might affect you is how it could affect your estate taxes. Because if you have situs assets in the United States, which could include investments, if you own individual stocks, it could be real estate and the likes, you're no longer getting the exemptions as a US citizen, and instead you're getting the same exemptions as everybody else, which drop you down to 60,000 limits. There are ways to manage around it, but this is definitely something that you want to manage prior to making that exchange, instead of thinking about it years later, because all of a sudden that can become a very expensive mistake to make of the changes to the estate tax rules for being a non-US citizen. Now, there's a changeover. I talked about how you set up your US assets. You can make a changeover if you do decide to renounce into more of a British system, and I can't think of anybody better to talk about that than Nathan.
All right, so we've taken the plunge. We've got rid of our US citizenship. We paid whatever costs we need to pay to get out. We no longer have to worry about reporting to the US, paying any US tax, or all of those constraints. The world is your oyster. You can now invest just as every other Brit does. Now, that's not to say that life is just go and do whatever. There are still things to think about, but I want to highlight some of the potential benefits that some people might feel is quite valuable. We've spoken about ISAs a number of times already, so let's just tick that one off the list. Your ISA is now 100% tax-free. That's tax-free on the growth, tax-free on the income earned on it. You can take money out of it tax-free whenever you want. So that's a nice easy win. But there's also other wins as well. Brian has spoken about the idea of having to be really careful on what investments you buy. You can't buy UK funds. You can't just go and buy any US mutual funds. You've got to be really particular on what ETFs you buy, and it'll be compliant in both jurisdictions, or limit yourself to individual shares and bonds. You've got rid of that issue. You can now go and buy any UK fund that you want. You can go into your bank and buy their standard fund should you want some. I'm not saying that that's the best thing to do or not, but you could if you wanted to. But the important bit there being you've got that freedom to pick and choose. And that might give you access to certain things that you might not have had before. So, for example, there are funds such as VCT funds, venture capital trust funds, or EIS funds, which give you additional tax reliefs in the UK. These funds, if you had bought them whilst you're a US citizen, would have been a PFIC, and so would have caused you more issues than the benefits potentially that you might have received. But all of a sudden, those things are now open to you. Also open to your other types of investments like structured products, investment bonds that defer when the taxation is due, and also potentially some more flexibility in terms of thinking around trusts, for example, or family investment companies and those types of structures outside of the US. Again, removing issues around PFIC rules or different rules around trust structures and things like that. All of that being said, you haven't removed the huge benefit of having advice, whether that's advice from a tax point of view, whether it's advice from a financial planning point of view, whether it's the benefit of having a professional investment manager help you. Those bits will still be there, because optimizing your position, whether you're a dual US-UK taxpayer or just a taxpayer in one jurisdiction, is still going to be hugely beneficial to you if doing it right. Now, I know we're running up close to our allotted time here, and people probably have a few questions, so I'll stop there and see if we can get some questions ticked up.
Brilliant. Okay. So, right. So as I said before, if you have any questions, feel free to drop them in the chat Q&A. So thanks very much so far, everyone, for your brilliant insights as always. Couple questions here that I wanted to cover. I think some of these are probably more towards Brian. So we'll start with a question about Social Security. So Brian, how is US Social Security taxed in the UK?
Oh, well, I don't want to get too deep into taxation because, well, I'm not certified to give taxation advice, but essentially most everything becomes taxable in the country that you reside based on the double taxation agreement. When it comes to Social Security benefits, the one great news is that these are detached from your citizenship, right? So if you're an American here in the UK and you get US Social Security, you're actually going to continue receiving that even if you rescind your US citizenship. So it's based on what you paid into the system, not based on your citizenship. So you don't have to go with the fear of potentially losing that US Social Security. One of the fun facts is if you call up the Social Security office, they're so helpful that they'll actually pay that Social Security in pounds into your UK bank account, so you can avoid some fees over there. Forgive me, high street banks, we just took our profit center away from you, because they'll do that for free.
Mm-hmm. And right, just sticking with the US just real quick as well. Regarding IRAs, what happens to a US rollover IRA if you renounce that? What happens then?
Sorry to be hogging the spotlight there, but I'll jump on that one as well. IRAs, it's just the same. So naturally the taxation stays the same as whether you're a citizen or not a citizen. But as we were talking about and alluding to, essentially that would become a US situs asset. It always is a US situs asset because the retirement account is back there in the US. In other words, it becomes significantly more important if you renounce to get that asset depleted and get it into non-US situs assets if it's sizable before you pass away. Please don't follow up that question with how do you know when you're going to pass away, because that one's too hard to uncover.
All right, brilliant. So thank you for those. So question from Miranda. She asks, I believe she means, how does the IRS view the 25% tax-free lump sum allowance on ISAs? Does anyone have any insight on that?
It's actually SIPs and qualified accounts that you get your 25% tax-free here in the UK. Now, I'm not a tax professional, so please take this with a grain of salt, but I have seen them actually take out those distributions and recognize those on the US side, but then I'm not qualified to actually give that advice. I've just seen that done before. Charlotte, do you have any insight? Did I hear?
Yeah. I've seen many clients take that position under the terms of the US-UK double taxation agreement. The US-UK double taxation agreement isn't 100% on that position. It's a position that is based on our understanding of the IRS interpretation of the rules. That being said, I have seen a number of clients do what you've just referred to there, take that 25%, invoke the treaty and work on the basis that that's tax-free from a US tax perspective. And with those clients where I've seen that, I haven't seen any pushback from the IRS. That is not to say that they could decide to have some questions or interpret the rules slightly differently, but the times that I have seen it, I haven't had any pushback from the IRS in that perspective.
Just for the benefit of 100% clarity, if anybody is thinking about withdrawing from an ISA, from a UK tax point of view, you can take everything out of the ISA whenever you want, 100% tax-free. If you are a US taxpayer, then you would be selling the investments in that ISA to do it, and so therefore there may be capital gains tax considerations.
Yeah, have a word with your tax person and your investment person before you decide to do that, please. We'll be able to give you, or whoever you're working with would then be able to give you an idea of the implications of withdrawing from an ISA. Have that conversation first so you know what you're dealing with before you decide to do so.
Brilliant. Okay. And now going over a bit to the Q&A section, Lisa has a question. At what rate is the tax or fee assessed on the 2 million plus assets? I believe that's in regards to what you were talking about, Charlotte.
Yeah. So the exit tax. So the exit tax isn't calculated on the $2 million threshold. The way that the exit tax is calculated, you're deemed to have sold everything that you own if you're a covered expatriate, as we discussed. You have a 700 and something tax-free allowance for the purposes of the exit tax, and the rest of it is subject to the tax rules according to the capital gains rules. How long have you owned that asset? Have you owned it for more than a year? It's a long-term capital gain. It'd be subject to tax at 20%. If you've owned it for less than a year, it would be considered an ordinary income capital gain calculation. So it's not quite the case that, oh, you've got $2 million, therefore you're going to be subject to tax at a certain bracket. It's more about, you would have to determine what your capital gain would be on all of those assets. You would reduce it by the 700 and whatever it is that I included on the slide, 727, I think, tax-free allowance. And then that remaining sum would be subject to the long-term or short-term capital gains rates. The IRS guidance isn't wildly helpful in terms of how you allocate that tax-free allowance. The way that I've seen it done is generally you would do a pro rata amount depending on the gain generated on each kind of bracket of assets. So unfortunately, it's not always a bright line. Oh yes, there you go, 20% on everything. It's more a case of looking through your various items, your balance sheet effectively, where's the gain, allocating the tax-free allowance amount, and then calculating the gain accordingly.
So with asset values potentially slightly lower in some investment portfolios at the moment, Charlotte,
yes,
it might be a cheaper time to be over that threshold rather than not.
Absolutely right. I mean, there's the issue to do with the foreign exchange rate at the moment, which is significantly in, expatriates' favour. And then, of course, the benefits of our interesting times when it comes to the markets at the moment as well.
Right, absolutely. Now, moving on to a question about trusts, if it's applicable. What happens if you're the beneficiary of a U.S. revocable or irrevocable trust if you expatriate?
So, when you're considering whether you're a covered expatriate or not, there are some complex rules, and I think they're possibly outside of the scope of a talk like this, but the value of certain trust assets would be considered within your net asset value for the purposes of determining whether you're a covered expatriate or not. The rules can be quite complicated depending on what kind of trust it is, whether it's a grantor trust or a non-grantor trust. Revocable trusts oftentimes are considered grantor trusts, but again, it would generally involve a review of the trust deed to understand the implications and how that would be treated on the beneficiary, as opposed to the individual who created the trust. So it may well be the case that your interest in a trust might push you over the threshold to become a covered expatriate. There are some rules about deferring the payment of the exit tax if you are the beneficiary of a non-grantor trust. So again, it would depend on the terms of this grantor, this revocable trust or non-revocable trust, whether it would fall within the criteria of grantor or non-grantor, and whether then that would be included within the $2 million covered expatriate threshold. So apologies, I can't really answer that one just straight off, but I'd be happy to go into some details afterwards with a little bit more information, perhaps.
Mm-hmm. Yeah, definitely. Okay, and I guess what could be related is the question of inheritance. I guess if the idea is if you're a dual US-UK citizen, are there any differences with regards to inheritance after renouncing?
Well, this is an interesting one actually, because we haven't spoken about it yet. If you're a covered expatriate and you've given up your citizenship, one of the rules, I think it's 2801, just to throw out a code section there for everyone's benefit, is that your US inheritors or people that receive gifts from you, the way that the exit tax works is that it effectively shifts the burden from the estate of the deceased person or the donor. So just to give you a bit of background, if you're a US person and on your death, you're subject to the federal estate tax, or during life, if you make gifts, you're subject to the federal gift tax. If you're a covered expatriate though, and you expatriate and you decide, actually, I want to give some gifts to little Johnny, my US citizen nephew, by being a covered expatriate, you're actually shifting the taxing burden to little Johnny as opposed to yourself. There is this strange rule whereby the recipient, the US recipient of a gift from a covered expatriate, has a requirement to subject himself to the gift tax. Now, the interesting thing here is while there's code sections and various kind of treasury rules, the IRS haven't actually produced a form to allow little Johnny to report this gift. So I do wonder, while these rules may be in place, who's actually reporting them to the IRS if the IRS haven't even generated a form? That might be slightly off topic though. Can you just repeat the question there, Josh? Sorry.
Yeah, sure. Absolutely.
I went down a little rabbit hole of my own there.
Yeah, not a problem. So this was in regards to inheritance. So basically, if you're a US UK citizen and you're thinking about renouncing, does that renunciation sort of affect the inheritance aspect?
Well, Brian did talk about the way that you would no longer have this really, really significant lifetime exclusion amount as a US citizen. At the moment, your lifetime exclusion amount is something like $12 million, wildly generous. If you expatriated, you would no longer have the benefit of that whacking great big lifetime exclusion amount, and you would be down to the wildly ungenerous $60,000 that would cover your US situs assets. So that is a really, really important consideration to make if you do have US situs assets.
So the key is to renounce before you have $60,000, right, Charlotte?
Yeah, I guess.
Right, it's brilliant. So thanks for that. There's a question, sort of a question about the exit tax for those who exceed that 2 million threshold. So we have talked about that a little bit.
Yeah.
I don't know if there was something more to expound on if perhaps, for instance, you do exceed that threshold.
Yeah.
So what exactly would happen there?
We've rather been talking about how to avoid being one of these covered expatriates and how not to be subject to the whole exit tax. So I appreciate we haven't spent very much time on what happens if you are indeed one of the covered expatriates who is subject to the exit tax. So we've spoken about how the exit tax will be calculated on the basis of the gain, the deemed gain, on your deemed sale of all of your assets before you expatriated. You've got this 700 and whatever it is tax-free allowance. The rest of it you would be subject to tax on. Now, there are some complicated rules about the fact that in many cases you haven't sold anything. Will you have the money to pay this deemed exit tax, this deemed capital gain on the sale of all of your assets? And so there are some rules where you can defer the payment of the exit tax over a period of time and then only pay the tax once you've actually sold these assets. Again, it's possibly not appropriate to go into all of the nuts and bolts on a call like this, and I'd be very happy, Edward, to have a conversation with you if you've got any particular queries in mind. But safe to say, it isn't just a simple case of you cutting a check to the IRS once you've become a covered expatriate, once you've submitted these forms. There are different rules depending on things like deferred compensation. So if you have pensions, the way that you're subject to tax on that is altered. If you've got, as we mentioned, interest in certain trusts, there may well be ongoing reporting required for you as a covered expatriate. If you were to receive distributions from these trusts, there's withholding requirements and so on and so forth. So it isn't simply a case of, if you are a covered expatriate, you pay the IRS a wad of money and that's it, you don't have to worry about it anymore. There may be an ongoing burden to deal with in terms of these withholding requirements if you're drawing down from certain kinds of pensions or trust arrangements, which, you know, if you have any specific questions about that, I'd like to help and go into probably boring amounts of detail for you.
Expanding on that really quick, Charlotte, because I think one of the biggest benefits of actually talking to a professional like yourself prior to the process of renouncing is going through different strategies.
Yeah.
You know, you talked about that 12,060,000, which there's plenty of politicians that think that that's not generous enough, and you and I think it's very generous. So it's, I think, all relative to who's lobbying you.
Yeah, exactly.
So you and I, we need to get better lobbyists.
Yeah, right.
Now we're able to double dip on that 12,060,000 as both an estate tax, but also a gift tax exemption. So all of a sudden, that generosity the government's given to you, you get to give that generosity to somebody else to reduce your estate before you renounce.
Exactly.
But you need to make sure that you do it legally and in the right ways and to the right people.
Absolutely.
So that you don't end up getting yourself in real trouble there. But I think those strategies beforehand and conforming with all the rules are some of the main reasons why they want to talk to a professional like you.
Yeah, very much so, very much so. I mean, it's particularly relevant if you are within shouting distance of being below that $2 million threshold. Why give yourself this headache of being a covered expatriate with the reporting that's required, if with a little bit of forward thinking, with a little bit of planning, you could get yourself underneath that threshold, not be a covered expatriate, not need to worry about the exit tax. And that can be something that can be, you know, particularly if you're in a mixed marriage situation where one of you is a US person, one of you isn't, that can be quite a helpful mechanism in place.
That's a big Christmas present.
I know, right? Very generous. Brownie points all round.
All right, so we'll probably only have time for maybe one question more before we have to wrap things up, but does a U.S. resident have the same tax liabilities as a U.S. citizen, particularly regarding inheritance? I guess it's probably good to clarify that aspect of it.
So I think we might be knocking into the idea of domicile there slightly. So a US resident, so someone who isn't a US citizen, but someone who is in the US on a green card or other kind of visa type situation. The rules around inheritance, so when we're talking about inheritance, presumably we're talking about estate taxes, as in the taxes that will be due when this US resident person dies. The rules are that if you're a US citizen or a US domiciliary, you're entitled to that whacking great big 12 million or very small 12 million, depending on your perspective on things. So that domicile issue is quite important. So a domicile, the rules around domicile are about where is your permanent place of abode, and do you have any intention to leave the US at any time. So the domicile issue isn't quite as straightforward as a residency issue. Residency from a US point of view is basically, you know, there's something called the substantial presence test. It's a kind of red line test to determine whether you're resident or not. Whereas the domicile issue is a bit woollier, there's a bit more intention involved. Do you intend to remain in the US? If you do fall within the US domicile criteria for estate tax, you do still have that very generous $12 million threshold. From income tax point of view though, if you're a resident, be that as a green card holder or someone who falls within the substantial presence test, it's as though you're a US citizen. You're subject to US tax on a worldwide basis. You're subject to the delightful reporting requirements that we've gone into lots of detail about. You have to tell the IRS about your non-US interests. So if you are a US tax resident, you are subject to these rules in the same way as a citizen. And that does include a US green card holder as well.
I think the important thing that we seem to have looped around to here is that none of these things are in isolation. We pretty much every question that has been asked, I think, kind of links back to whether you're thinking about income tax or investment efficiency or residency, domicile, citizenship. It's all interlinked, and trying to just tackle one question in isolation will quite often mean that you miss something else that's quite important. So before any kind of individual decision is made, take a step back, look at the big picture, get some advice, and make sure that you're considering the whole journey of what could be affected, and then that way you'll be able to make the best decisions and plan in advance to make sure it's as efficient as possible for you individually.
Absolutely. All right, so I think we've run out of time, which I'm very sorry about, because we have a lot of brilliant questions and I really wish we had time to get to all of them. But we will be reaching out with the contact details for each of our speakers. If you'd like to get in touch, please ask any questions after this webinar. We will be putting the recording up on YouTube. So once again, thank you very much for attending our webinar, ladies and gentlemen. And thank you very much for your time today. So Brian, Charlotte, and Nathan. So, and we just hope you have a great rest of the week. And yeah, take care.
Josh, I'm going to steal one last question right there.
Yeah.
Just from the vantage point, I'm not going to answer the direct question. They asked who they should go with on a certain issue. If you go to any of the three of us, we know each other very well. And if you're with the wrong person, we'll direct you to the right person. So whatever inquiries you have, we'll probably send the hard questions over to Charlotte as you guys.
Oh, great.
Josh, thank you for hosting. Nathan, Charlotte, always wonderful to see you both.
Thanks, everybody.
All right.
Cheers,
well,
guys.
all right, that's it from us. So take care, everybody, and keep in touch. Don't be afraid to reach out, and we'll speak soon. Thanks a lot.
Thanks, everyone.
Thanks, guys.
Thanks, everybody.
Bye.